Welcome to RBC's Markets in Motion podcast, recorded October 8th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, the results of our latest quarterly global RBC Analyst Outlook survey and their impact on our U.S. sector recommendations. Two big things you need to know. First, globally, our analysts are generally constructive on performance, valuations, and the impact of lower interest rates, with materials most in favor and consumer staples most out of favor across all of the outlook questions that we asked. Second, within the U.S., we are reiterating our overweights on financials and materials, upgrading healthcare to overweight, and downgrading utilities to market weight. Energy remains a tactical overweight, but does go on downgrade watch. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. First, the global survey results. Globally, our analysts have a slightly bullish tilt in their performance outlooks for their industries over the next 6 to 12 months. Meanwhile, they have a modestly constructive view on valuations, mixed views on demand, and a more clearly bullish view on the impact of lower interest rates. At the global sector level, performance outlooks are most bullish for materials and financials. Valuation assessments tilt most constructive for materials and financials as well, along with several other sectors, including tech and energy. Sector views on the demand environment are mixed, with the most positive tilt for healthcare and negative tilts for consumer-oriented sectors like consumer discretionary and staples, along with energy. Our analysts are broadly enthused about the positive impact of lower interest rates for most sectors, but this is true for financials to a lesser degree than others. Across all four of our core outlook questions, enthusiasm for materials is the highest, and enthusiasm for consumer staples is the lowest. Regionally, performance outlooks and valuation views are more constructive in Europe and Canada than they are in the U.S. Moving on to takeaway number 2, our U.S. sector calls. Within the U.S., we are reiterating our overweights on financials and materials, upgrading healthcare to overweight, and downgrading utilities to market weight. Energy remains a tactical overweight, but does go on downgrade watch. Here are the key things driving our views and changes on these sectors. For financials and materials, both are value cyclical-oriented sectors that benefit from a rotation out of mega-cap growth, and both did capture some of the most optimistic performance outlooks in the survey among our U.S. analysts. We also like financials' reasonable valuations and positive earnings and sales revision trends on our own quant work. For materials, we like the sector's improving funds flows, along with our analysts' high conviction that the sector will benefit from lower interest rates relative to other sectors. Swapping utilities for healthcare was admittedly a tough call. Our U.S. analysts are optimistic on performance for both sectors, but they're more bullish in healthcare. Healthcare also captures the strongest demand assessment from our U.S. analysts. On our own quant work, valuations look better to us in healthcare than utilities right now. The latter has turned slightly expensive. The strong funds flows that have been seen in utilities this year also appear to be stumbling in recent updates, while healthcare funds flows do continue to see some steady improvement. Deciding what to do with our energy overweight was another tough call. Energy performance outlooks among our U.S. analysts have deteriorated since our last survey in July. They're frankly more neutral today than bullish. And while they are constructive on valuations and the impact of lower interest rates, their view on demand is weaker than what we're seeing in other sectors. But on our own quant work, valuations do remain compelling for this sector, and funds flows are starting to improve at the margin, getting less negative. We've primarily viewed this sector as a hedge on the return of inflation pressures and escalation of geopolitical risks in our portfolio. We're comfortable letting this sector stay on our list of overweights for now, as long as geopolitical tensions remain high, but we do plan to reevaluate if and when geopolitical tensions ease. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.